If you look at the financial data today, July 20, 2026, you're essentially watching a split screen movie. And the two main characters in this movie are reacting to entirely different realities. So on one side of the screen, you have the S&P 500, which is up nearly 10% for the year. Inflation has cooled down, and the AI boom is providing this massive market tailwind. It looks like a victory lap. But then you look at the institutional titans, the people managing trillions of dollars, and they are quietly feeling for the exits in the dark. Our mission with this analysis is to unpack a stack of sources ranging from airline earnings to international trade data and figure out what is actually driving these contradictory market incentives.
And JP Morgan Chase CEO Jamie Dimon is definitely the loudest voice in that dark room right now.
Yep.
He recently went on record stating he point blank refuses to buy long-dated U.S. Treasuries, and he has zero interest in buying the broader stock market at current valuations.
Which is a remarkably blunt thing for the head of the largest bank in the United States to say publicly. If he's completely writing off a 10-year treasury, is he basically warning that the market is severely underestimating the geopolitical risks and the sheer scale of government borrowing?
That is exactly his underlying logic. It comes down to math that the broader market is just seemingly ignoring. We're looking at the persistence of massive government deficits combined with rising military spending all around the globe. That brings us to this concept of the bond vigilante.
The investors who basically hold governments hostage if they spend too much, right?
Yeah, these are fixed income investors who look at fiscal irresponsibility. So government spending far more than they take in, and they simply refuse to buy the debt unless the yield goes up to match the risk. Dieman believes that even if inflation stays near the Federal Reserve's 2% target, the sheer volume of government borrowing should realistically push the 10-year Treasury yield up to somewhere between 4% and 4.5%.
And if the risk-free rate of return, the yield you get just for holding U.S. government debt, if that jumps to 4.5%, suddenly taking a massive risk on some highly volatile tech stock just to earn a 5% return makes absolutely no financial sense. The gravity of those bond yields would just pull down the valuations of everything else in the market.
Which is what makes the other side of our split-screen movie so fascinating, because while billionaires like Diamond are urging extreme caution and hoarding cash, regular retail investors are sprinting in the exact opposite direction. We're seeing this massive wave of younger demographics enthusiastically pouring their savings into the most volatile assets they could possibly find.
The recent trading data on AMC shares is just a perfect snapshot of this reality. I mean, the stock surged roughly 150% over a 4-month climb. But it wasn't institutional buying. That spike was almost entirely fueled by retail traders piling into call options after the record-breaking box office numbers for the movie The Odyssey. We saw over 300,000 options contracts traded right out of the gate on a single Monday earlier this year. They aren't just buying the stock, they are deliberately buying leveraged derivatives to maximize their exposure.
And this behavior is absolutely not isolated to the United States. In South Korea, retail investors, who are locally referred to as ants, they've driven the Kospi index up more than 50% this year. They are heavily concentrated in tech and AI stocks. The resulting volatility is so extreme that trading on the benchmark index has been halted by circuit breakers 7 different times this year, just to stop the panic selling.
So the system actually has to forcibly pause trading just to cool down the retail frenzy.
Exactly. And over in Australia, you have 20-somethings adopting the exact same strategies, deliberately seeking out these massive concentrated swings in the market.
You know, traditional financial media loves to paint these young investors as reckless gamblers, just treating the stock market like a casino. But if you actually look at the macroeconomic environment they graduated into, this behavior starts to look like a highly rational, if somewhat desperate response to a very specific problem, which is shrinking purchasing power.
The demographic data strongly supports that read. For anyone under 30, the last few years of inflation fundamentally broke the traditional model of building wealth. Stashing your money in a standard savings account or, even a slow and steady index fund effectively means you are losing wealth in real terms once you factor in the actual current cost of housing, food, and energy.
So if the safe path mathematically guarantees that you will fall behind, the only logical choice is to take on asymmetrical risk. That totally explains why these retail traders are treating market sell-offs not as warning signs, but as a test of conviction. They are intentionally buying the dips on highly volatile assets because hitting a moonshot is perceived as their only viable path to achieving actual financial security. To them, traditional fundamentals just do not matter. Momentum is the only thing that matters.
And that pursuit of extreme efficiency and momentum at the consumer level actually transitions perfectly into how major corporations are adapting their own revenue models. Because instead of relying on broad traditional sales growth, companies are increasingly leaning on captive audiences. Ryanair's latest first quarter earnings report, which came out recently, offers a brilliant masterclass in this approach.
Let's unpack those Ryanair numbers because the headline figures actually look quite weak. Their first quarter profit dropped 34% to roughly $615 million, or about 538 million euros. They blame this on consumer hesitancy surrounding the Middle East crisis and a massive spike in unhedged fuel costs across the broader airline industry. And their response to that consumer anxiety was to actually lower ticket fares by 6% to stimulate demand.
Right, and slashing your prices when industry costs are rising sounds like a terrible business strategy. But that is only if you don't understand how airlines actually make money today. Analysts refer to Ryanair's underlying strategy as a load factor active revenue passive model.
Load factor just being airline jargon for the percentage of seats they manage to fill on a given flight.
Yes, precisely. Ryanair prioritizes a 100% full plane above literally all else, even if they have to sell that physical seat at a loss.
So they're essentially operating as a flying convenience store. They take a hit on the actual seat just to trap you in a metal tube for 3 hours. And once you are strapped in, they monetize you aggressively. They charge for a cup of coffee, they charge for your overhead bag, they sell you priority boarding, they pitch a rental car partnership mid-flight. Looking at their financials, those ancillary sales make up roughly 25% of their total revenue. That is staggering.
The convenience store analogy is dead on. But the real structural advantage that allows Ryanair to take a loss on the ticket while their European competitors go bankrupt is their financial armor. Specifically, they utilize a highly conservative fuel hedging strategy. They already have 80% of their 2027 jet fuel locked in at $67 a barrel.
Wait, to put that in perspective, average jet fuel prices recently surged to $127 a barrel. So Ryanair is paying roughly half the going market rate to fly their planes.
Half the rate? Yes. And on top of that artificial fuel subsidy they created for themselves, Ryanair paid down its final $1.2 billion bond in May. So the company is effectively debt-free. They own their assets outright. So while weaker airlines are getting absolutely crushed by $127 a barrel fuel and high interest rates on their corporate debt, Ryanair can comfortably absorb those lower ticket prices. Their strategy is to intentionally starve the competition of passengers, capture the market share, and extract all their profit from your luggage and your coffee.
If we are talking about the raw math of extracting revenue from a captive audience, the ultimate example of that just wrapped up. The 2026 FIFA World Cup concluded with Spain defeating Argentina 1-0. And the revenue projections for FIFA from this single event are staggering, coming in at over $9 billion.
And that $9 billion figure is a direct result of aggressively scaling the product. FIFA expanded this tournament to 48 teams, which resulted in 104 matches over a 6-week period. From a pure monetization standpoint, more matches translate directly into more broadcast inventory to sell to networks, more sponsor activations, and obviously massive ticket sales. The median ticket price topped $900, and stadium utilization remained at 99% throughout the group stages.
But there is a massive political layer to that $9 billion that explains why the tournament keeps growing, right? FIFA is technically a nonprofit organization, so out of that massive revenue pool, they distribute roughly $2.7 billion directly to member nations, specifically targeting smaller countries to help them build football infrastructure.
Yes, it functions as this brilliant, self-sustaining circular economy. By funneling billions to those smaller nations, FIFA President Gianni Infantino effectively secures the voting bloc he needs to maintain absolute control of the organization.
Which guarantees enthusiastic support for even more commercialization. I mean, Infantino is already floating the idea of a 64-team tournament for 2030. That would feature almost a third of all eligible countries on Earth. It seems like when you distribute that much cash, the member nations will happily vote against the physical limits and health of their own players just to keep the institutional revenue flowing.
Absolutely. And, while we track these massive shifts in how capital moves across the sports and corporate landscape, a quick reminder that you can find financial candy, brain candy, and classic audiobooks over at clarineratio.com. And I bring that up because it is fascinating to watch an entity like FIFA wield its financial heft to secure political outcomes, because we are now seeing national governments adopt that exact same playbook. They are stepping out of their traditional regulatory roles to act directly as aggressive venture capitalists.
The U.S. government is really at the forefront of this shift right now. If we look back to August 2025, rather than just handing out basic research grants, the government took an $8.9 billion equity stake in the chipmaker Intel. Fast forward to today, mid-July 2026, and that specific stake has skyrocketed 372% to a staggering $42 billion.
Right.
And the Pentagon is doing the exact same thing, backing startups like Vulcan Elements with a $620 million loan to jumpstart domestic rare earth mining.
The core friction here is this collision between national security priorities and free market efficiency. The government is intentionally using its massive financial leverage to break foreign monopolies, specifically China's dominance over the rare earth minerals that are absolutely vital for manufacturing advanced fighter jets and drones. Policymakers have basically calculated that distorting the market is a necessary price to pay for supply chain sovereignty.
Sure, a 372% return on Intel looks phenomenal on a Treasury spreadsheet today, but aren't we risking the creation of state-protected zombie companies down the road? We saw this happen historically with the U.S. steel industry. Decades of government tariffs, subsidies, and eventually the implementation of golden shares, where the government holds special veto power over major corporate decisions. All of that ultimately insulated the industry from true innovation. They didn't have to compete globally, so they essentially rotted from the inside out.
The American public actually seems to sense that long-term risk. Recent polling indicates 49% of Americans oppose the government taking direct ownership stakes in private companies. But the administration is pressing the gas pedal anyway, and not just with equity investments. They are wielding trade law as a blunt force instrument. The Trump administration is currently imposing 50% tariffs on a wide range of Canadian goods, including dairy, alcohol, and motor vehicles.
And what's wild is they are executing this using Section 338 of the 1930 Tariff Act. That is an incredibly obscure piece of trade law that has effectively sat dormant since 1949. It gives the president the authority to impose tariffs of up to 50% on goods from any country found to be discriminating against U.S. commerce.
By dusting off Section 338, the administration is intentionally bypassing the traditional negotiated frameworks of the USMCA Free Trade Agreement entirely. It is a unilateral enforcement lever designed to inflict immediate severe financial pain without having to wait around for international arbitration.
But when you combine that kind of raw, aggressive government intervention with massive private capital, you eventually get explosive standoffs. And that is exactly what is brewing in the UK right now for the new Prime Minister, Andy Burnham. Bond markets are incredibly jittery, with UK 10-year borrowing costs rising above 5%. And a major catalyst for that panic is Thames Water. This is a critical utility providing service to 16 million people, and it is currently suffocating under roughly $26.8 billion, or about 20 billion pounds in debt.
Thames Water is basically teetering on the edge of total collapse. The private lenders who hold that massive debt have presented a rescue package to the government, but it is highly controversial. They have offered to write off roughly $12.6 billion of that debt and inject fresh cash to keep the water flowing.
But the conditions attached to that write-off are astonishing. The lenders will only forgive the debt if the government grants Thames Water leniency on future pollution fines. So are the lenders essentially holding a critical piece of national infrastructure hostage, telling the government to look the other way on environmental regulations, or the company dies?
That is exactly the leverage play. Now, the government has a few tools to fight back, but they are full of legal landmines. Prime Minister Burnham has the power to place Thames Water into what is called a Special Administration Regime, or SAR. This is a temporary form of public control, designed simply to stabilize the firm until a new private buyer can be found.
But temporary control doesn't solve the underlying $26.8 billion problem. If Burnham decides to call the lender's bluff and pursue full, permanent nationalization just to protect the water supply, doesn't the public just inherit a massive, toxic asset?
That is the exact trap the lenders have set. Sources indicate that if the government forces permanent nationalization, the lenders are preparing a massive legal challenge to demand immediate payment in full of the outstanding debts. If they win that case, an enormous private corporate failure instantly transforms into a multi-billion-dollar public liability funded entirely by taxpayers. It is a brutal game of financial chicken.
That dynamic, where policy mandates completely misjudge the reality of ground-level economics, brings us to a glaring agricultural failure over in Colombia. The government there has spent years trying to implement crop substitution programs, specifically the PNIS and the newer Renhacimos initiatives. They basically offered farmers around $11,000 to uproot their coca plants and replace them with legal crops like cassava and plantain.
The policy stems from the 2016 peace deal. The overarching goal was to build sustainable, legal livelihoods for roughly 100,000 families in rural provinces. Yet as of today, the cultivation of coca has actually surged to record levels, exceeding 250,000 hectares. And the reason this policy failed has very little to do with cartel coercion and everything to do with raw unit economics.
Right, it's the inescapable math of moving physical goods. If you are a farmer in a remote province that is reachable only by river and there are absolutely no paved highways, growing cassava is a guaranteed path to bankruptcy. Cassava is incredibly heavy, it's bulky, and it spoils quickly. If you harvest a ton of it, it will simply rot in the mud before it ever reaches a commercial buyer.
Contrast that with the logistical reality of coca. The plant yields 3 to 4 rapid harvests every single year. The farmers don't ship the bulky leaves down the river, they process it locally into coca paste. That paste is highly concentrated, incredibly portable, and it has a guaranteed buyer price right at the farm gate. An entire harvest that sustains a family can literally fit into a single backpack.
Because the state's substitution programs handed out cash for seeds but entirely failed to construct the necessary physical infrastructure, the paved roads, the cold storage logistics, the technical support, the legal crops never stood a chance. The farmers aren't acting maliciously, they are acting as entirely rational economic agents in a severely constrained environment. They simply returned to growing the only crop that could survive the journey out of the jungle.
When we pull back and look at the distinct pressures we have unpacked in this exploration, a clear pattern emerges. The unifying thread across all these stories is the sheer, unstoppable force of economic incentives. Whether it's a 26-year-old in Seoul taking concentrated risks on AI stocks because standard savings yield negative real returns, or an airline selling tickets at a loss just to charge you for the luggage in the overhead bin, or a Colombian farmer returning to a reliable cash crop when state subsidies fail to pave a road to market. Individuals and corporations will always ruthlessly seek efficiency, regardless of the rules written by policymakers.
The reality check for the coming months is the sheer hubris of state intervention. When national governments step in to play venture capitalists with microchips, or when they threaten to permanently nationalize debt-saddled water utilities, they're betting massive amounts of public capital that they can outsmart these organic, ground-level market forces.
And history strongly suggests that betting against raw economic incentives rarely ends with clean compliance. Sweeping state interventions typically just create an entirely new set of bizarre financial loopholes and secondary markets. The defining question for you to watch across all these sectors is who will adapt faster to the friction: the policymakers trying to force compliance, or the consumers and corporations rapidly finding the workarounds.
It is a race that never actually ends. Thank you for joining us for this analysis. Stay curious, keep questioning the incentives behind the headlines, and we will catch you next time.